Welcome to This Explainer. Today, we're breaking down some absolutely fascinating financial research. We're tackling a pretty massive goal, figuring out how to uncover the hidden wealth potential in your investments. As you'll see, the data suggests we could potentially boost your mutual fund returns by 10% or more over the long haul. And get this, we can do it without taking on wild, uncalculated risks.
Okay, let's dive into this. The research we're looking at poses a central and honestly, a slightly provocative question. Can mutual fund returns actually be improved significantly without taking crazy risks? I know, it sounds a bit too good to be true, doesn't it? But looking at the math, well, the definitive answer seems to be yes.
To understand exactly how, we've got to look at a rather surprising truth. You see, we often cling to this myth that picking bad funds is the ultimate wealth destroyer. We agonize over star ratings, we obsess over fund managers, but the reality? Poor investing behavior destroys wealth far more effectively than any fund ever could. The real secret, hiding in the data, is that small, strategic improvements in how you behave as an investor can actually boost your long-term outcomes by a massive 5 to 10%. Let's look at how the math backs this whole thing up. Here's our roadmap for today. First, we'll look at the real wealth killer. Then, Strategy 1, Step Up SIPs. After that, we'll cover Strategies 2 and 3, which are time and balance, followed by Strategies 4 and 5, focusing on costs and fear. And finally, we'll put it all into motion with the giant wheel momentum. All right, Section 1, the real wealth killer, understanding mathematical friction. So what exactly is mathematical friction? Well, it happens when poor behavioral habits cause the natural, beautiful process of compounding to just slow down dramatically. It's exactly like driving a car with the emergency brakes slightly pulled up. I mean, sure, you'll eventually get to the grocery store, but you're burning out your engine and wasting a ton of gas to get there. And here are these specific behaviors causing that exact friction. Number 1, your SIP, your systematic investment plan, never increases over time even as your income grows. Number 2, your money just sits idle, waiting for that perfect moment in the market. Number 3, panicking and exiting during a market crash. And number 4, leaving your portfolio completely unmanaged. Shifting your mindset to remove these obstacles is absolutely crucial because it allows compounding to finally accelerate. Moving right along to Section 2. Strategy 1, Step Up SIPs, the biggest wealth accelerator. This strategy directly attacks that first point of friction we just talked about. You know, most investors make a major mistake, keeping their SIP exactly the same for 20 years. But look closely at this comparison. If you have a normal SIP, investing 10,000 rupees monthly for 20 years at a 12% growth rate, you invest about 24 lakhs and end up with a very respectable 99 lakhs. Not bad, right? But check out the step-up SIP. By simply increasing your monthly contribution by just 10% every year, you invest roughly 68 to 72 lakhs total. But your final value? A staggering 1.75 to 2 crores. By simply bumping up your investment in line with your salary bumps, your final wealth almost doubles. Why? Because those increased contributions start compounding on themselves. It's a real game changer. Okay, Section 3, Strategy 2 and 3, Time and Balance. And this brilliantly illustrates the unbelievable cost of delaying your investments. Let's look at the differences assuming that same 10,000 rupees SIP and 12% growth. If you start at age 25, you've got 30 years in the market, resulting in an incredible 3.5 crores. But if you delay just 10 years to age 35, your final value completely plummets to 99 lakhs. Wait until 45, you're looking at just 23 lakhs. The difference is literally staggering. Compounding silently gets delayed. The true power here isn't about being a genius. It's just about time in the market. Time is absolutely crucial, but so is balance. Here's a backtest comparing a standard 60% equity and 40% debt portfolio over a 15-year period. With zero rebalancing, you end up with a 10.5 to 11% return, but with extremely high volatility. It's a really bumpy, stressful ride. However, with simple annual rebalancing, basically just moving money around once a year to keep that 60-40 split, you actually bump your returns up to 11 to 12% and experience way lower volatility. Rebalancing acts like a silent booster. It forces you to buy low and sell high, protecting your profits while controlling risk. It really improves the consistency of your returns. Next up, Section 4. Strategy 4 and 5. Costs and fear. Now, what's really interesting about this slide is how a seemingly tiny number can totally destroy your wealth over time. Can small fees really matter? Look at this simulation of a 10 lakh investment over 20 years. If your net return is 12%, your final value is roughly 96 lakhs. But if a higher expense ratio from your mutual fund drags your net return down to just 11%, your final value drops to 80 lakhs. Let that sink in for a second. Just a 1% difference in fees destroys 16 lakhs of your hard-earned wealth. Over decades, those tiny percentages become absolutely huge.
Which brings us to strategy 5, and honestly, this is probably the most difficult one emotionally: how you behave during market crashes. Notice how different behaviors impact your long-term wealth here. If you give in to fear and stop your SIP during a crash, you get weak compounding. You completely miss the recovery. If you hold steady and continue your SIP, you get a much better recovery. But if you view fear as an opportunity and actually increase your SIP during a crash, you secure a strong, massive long-term wealth boost. You're basically buying assets on sale. This is exactly how the pros view periods of fear, as prime opportunities to quietly build immense wealth.
All right, final section. The giant wheel momentum, your 10% framework. So when people ask me where that elusive 10% improvement actually comes from, the answer is right here in this framework. It doesn't come from one magic trick, and it definitely doesn't come from picking one lucky stock. It comes from combining all these small optimizations. Step-up SIPs give you massive growth. Starting early gives you an exponential time advantage. Rebalancing provides consistency. Lower costs offer a silent compounding boost. And investing during fear, that gives you a powerful long-term advantage. Successful investing is fundamentally more behavioral than it is predictive. To give your brain a quick break from all that math for a second, hold on to this really simple, powerful analogy. Wealth creation is exactly like pushing a giant, heavy wheel. At first, it feels like a tremendous effort and the wheel barely moves. But small, consistent pushes over the years eventually create absolutely unstoppable momentum. Once that wheel is spinning fast, compounding is basically doing all the heavy lifting for you. And that leads us to our core philosophy for today. If there is one singular thought you take away from this explainer, please let it be this: extraordinary wealth usually comes from ordinary investments done extraordinarily consistently. You don't need a perfectly engineered, super complex portfolio. You just need discipline. You need a system that removes that mathematical friction. Small improvements in your behavior today will compound into massive wealth differences decades from now. Ultimately, that is how you win the game. This conversation is for educational purposes only. Mutual fund investments are subject to market risks. Past performance does not guarantee future returns. Please consult a qualified professional before investing. With that in mind, take a hard look at your own portfolio today. Are you letting mathematical friction steal your wealth, or are you ready to finally take off the emergency brake?